Tumultuous times, and of course a little bit of good news. In fact, two pieces of good news today. It seems that action has been taken with regards to the EFSF fund in Europe and the banks there. And then we also had fantastic GDP numbers out of the US for the third quarter, clocking in at 2.5%. Within all this uncertainty, good and then bad news, how does one decide on asset allocation on the global level? So we're talking about international asset allocation.
Well, from an international asset allocation perspective, it's important to take the long view. And there are a couple of principles or three legs to the stool of asset allocation. First, broad diversification. Most investors have portfolios that are skewed towards domestic equities and bonds. If at all possible, it's better to broadly diversify. Make sure that you don't just have stocks and bonds, but you have other diversifying assets like property, like foreign currency denominated bonds, like bank loans and high yield debt if you can get it. That's the first stool. The second stool would be systematically rebalancing. You can add considerably to your return over time by selling what goes up and buying what goes down. It's a contrarian strategy that's difficult to execute, but it will significantly add to your returns in the long run. Lastly, be price conscious. Pay attention to where dividend yields are, where bond yields are. Right now, probably the least attractive investment in the world is developed market bonds. That's not where you ought to be. You have terrific dividend yields in Europe. European stocks and European credit are actually very attractive right now.
Let's just touch on the second point there when you said systematically rebalance your portfolio. Tell us how often you should actually be doing this. We know that many investors out there and portfolio managers say they do it maximum on a quarterly basis. Is this how often you should be embarking on this trend, given the fact that everything is speeding up so extensively and we just keep hearing so much news coming through on a daily basis, never mind a quarterly basis? Sure,
it's best to tune out the daily noise. Even quarterly rebalancing is more than necessary and in fact more than optimal. Annual rebalancing is probably the best, and the reason is that over the short run markets display momentum. Stocks or asset classes that went up versus the rest of the market last quarter are a little more likely than not to continue going up versus the rest of the market next quarter. However, over longer periods, 2, 3, 5-year horizons, there's mean reversion in markets. Whatever has gone up over the past 2 or 3 years is more likely to go down over the next 2 or 3 years. So you can be very patient and rebalance your portfolio annually. You were talking about the developed world, and of course the bond yields there are nothing compared to what we see in the emerging market space. But then I still watch in awe, and I watch the 10-year Treasury yield, and just when we think it's going to too high levels, it just plummets once again to around 2.5%. Tell us why investors right now are still running to US Treasuries. Is it really just about fear? Of course it is. While you can be certain that you're going to get a low return by investing in US Treasuries over a 10-year horizon, the 10-year yield is the return you're going to get if you invest in US Treasuries for a 10-year horizon. The return that you're going to get over the next month or the next quarter or even the next year is highly uncertain. But still, since you know that you're going to get a very low return over a long horizon, it's time to start moving away from those assets. With regards to having exposure to European debt, having exposure to European equities, would you brave that market right now? I would start averaging in. I don't think that I would, and never would, put a huge concentration in my portfolio in any one asset. But European markets, as I say, you have a dividend yield of maybe 5% in Europe versus a dividend yield of only 2% in the US market. If you're going to have developed markets exposure in your portfolio, I would definitely skew that towards Europe. With regards to the way that we've seen the Dow Jones and S&P performing over the last 10 years, has actually been a flat performance, and looking at emerging markets in particular, the South African stock market, we've had phenomenal performance over the last decade. Some would argue that emerging markets have already had their run. Do you agree with that? Are you concerned about some of the valuations that we see here in South Africa, for example, in the emerging market space, relative to the global market? Where are the most opportunities to be had? I think the opportunities over the next decade will remain in the emerging markets. If we look at the estimated return over the next 10 years for the US market, you start with the dividend yield, that's 2%. Next, you add the very long-term growth in real earnings per share, which is about 1.5%. At inflation, that's an unknown, but say 2%, that's what the TIPS market is implying for inflation in the US, we get to a 5 or 6% return. And that's before thinking about the headwinds that we face in the developed markets. The demographics don't look good and the debt looks just terrible. So I would say best case we get a 5 or 6% return in the US equity market. Emerging markets are much better. Look at where the interest rates are. Look at the productivity growth. Look at the population growth. I continue to think that emerging market equities will outpace developed market equities in the decade to come.
You were talking about diversification, and that's the way to go. What about gold? What is your view on gold? And I suppose if you had actually gotten the story right, you would be saying that gold is a fantastic asset class, I'm assuming. So, yes, tell us.
Well, actually, I don't even think gold is an asset class. Gold is a commodity. Gold doesn't pay any interest. Gold doesn't pay any dividends. Gold has no economic value. It's merely a commodity. It's a monetary asset. That doesn't mean that it isn't a useful diversifier to a portfolio. But the problem with gold is that many people will use gold as a hedge against political uncertainty. Other people use gold as a hedge against monetary uncertainty. If you have a lot of people who are trying to use gold as a hedge for both purposes at the same time, it may not serve as a good hedge against anything.
With regards to buying protection, in a sense, how would you protect yourself? Is just mere diversification enough protection in the long term?
Well, I think the one other thing that you want to do besides diversification and systematic rebalancing is be price conscious. Avoid overpriced assets. Is gold an overpriced asset? I don't know, but it kind of looks that way. Commodities have gotten to be rather expensive generally. I would go for the cheap assets. And as I said, I don't find any cheaper assets right now than in Europe.